Welcome to CEO Money. I'm Michael Yorba. Thanks for joining with us. I have Craig Dickens. He is the CEO and founder of Merit Harbor Capital on the show with me. Craig, welcome to the show.
Thanks, Michael. Glad to be here.
All right, I'm glad.
And congratulations on the new studio and the traction that CEO Money has received. It's really exciting to watch you guys grow and take off.
Thanks, Craig, and I'm glad you could be a part of it too. Appreciate that. You know, there's a lot that has been happening since you were last on the show. Give us an update on the market, let's say for M&A, and specifically, if I can, for CEOs and entrepreneurs looking to, say, sell. What's the crystal ball say? I mean, where do you see the markets going for valuation and of companies and people trying to sell their companies?
Yeah, it's been an interesting time. I think it's been a few months since I've been on. Obviously, we got through the 2018 cycle, and December 3rd, I think we had an inverted yield curve, which is always an early indicator of a recession. I think we've seen from a deal activity standpoint, multiples for companies selling have probably peaked. So we're kind of at an interesting inflection point in the marketplace. Marketplace has given us a couple of other indicators. Debt, commercial debt is tightening slightly. I think the real estate sector, those folks that are investing in real estate have seen, some nice appreciation over the last few years. Certainly in our market up in Seattle, we've seen that start to skyrocket. But the tea leaves are turning there a little bit as well. We're seeing credit tightening a little bit. We're seeing loan-to-cost calculations for investing in new development projects come down. Typically, a real estate developer could get 65% loan-to-cost on a debt product to help them finance development. We're now seeing certain sectors like limited service hotels and other sectors in the 50% loan-to-cost range. So you take a bunch of these economic factors, despite the market being, at high multiples and a lot of cash in the market, we're starting to see the tea leaves tell a little bit of a different story. So I don't want to be one of those guys that predicts doom and gloom. I don't think it'll be that dramatic, but we are seeing some general slowdown.
All right. Now, let's talk about some of the strategies that CEOs and entrepreneurs should take now that the tea leaves are shifting.
Yeah, I think first and foremost, we have a responsibility as CEOs to protect our shareholders and to deliver shareholder value, whether it, is in good times or in bad. And oftentimes value can be defined by, two different things. First and foremost, creating value, growth, and profitability. And then ultimately de-risking future cash flows, de-risking a company can increase its value as well. So I think ultimately, as companies assess perhaps a slowdown in growth, they really need to start looking at their capital stack and look at their the amount of debt that they're carrying. And it might be a great opportunity during that inflection point for those smart CEOs that are, really kind of spending time thinking about where their business could be in 12 months, 18 months, 24 months, to assess your capital stack, maybe change your debt structure, your mix between debt and equity. Those are prudent moves to make in this marketplace. And there are some creative strategies, obviously, that, looking at the term of your debt, looking at how your interest is calculated and paid, and really getting creative with, how you use debt as part of your capital stack. I think another option that is, again, still riding the wave of a lot of capital available in the markets. There is a group of private equity and other investors like SBIC firms that are making minority equity investments in companies. So, if you've got some gray hair like I do and you're thinking, all right, how much debt do I want to tolerate? You might want to consider a minority recapitalization and have an equity partner brought into your company to perhaps retire some debt, or even for you personally to take some chips off the table. There are a lot of investors that are willing to make a minority investment in good operating companies. So, my advice to CEOs over the next 12 to 24 months is might start to, instead of grow, offense, 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 start to think about, defense being your best offense.
Got it. Sound advice. All right. Are there any other practical or operational things that CEOs should consider to ensure that they're building value and, well, if you will, becoming more recession resistant and to better prepare for what even they may not know is coming? Just because sometimes you don't know what you don't know.
Yeah, I mean, so there's a couple of options. If you buy into the fact that there might be a little bit of a slowdown in the economy, you need to personally take stock and assess whether, it's the peak of the market. I might want to sell now versus wait for 5 years. I might want to consider an encore career. That's always an option. Certainly, some folks can do nothing and just kind of ride it out, business as usual. I think from a operational and tactical standpoint, it's surprising because of all the unemployment numbers will tell you that, unemployment is low and it's hard finding good talent and talent is migrating to other areas. But we've found in our own business, and we're counseling clients to really think of this inflection in the market and people moving from one employer to another to look to upgrade talent. People don't always move from one company to another because they're disgruntled or they're not challenged. They might move for a different type of opportunity. And we've personally been surprised, even in a tight labor market, that we've been able to upgrade talent and really kind of bring on some folks that can move the needle that just want a change from their current environment. So for those that are frustrated by that, might be from an operational standpoint, a good time to test the waters, even though the popular sentiment is, the labor markets are tight. I think that is one area that, CEOs can focus on and keep building that leadership team. The other is kind of the technology and efficiency play, in that those companies that invest in technology before a business slowdown, generally come out of the other end a lot stronger and with kind of a greater flywheel effect. So, if you're thinking about ways you can invest in technology and, efficiency in your business, now might be a good time. You might say no to the CapEx and buying the big brand new machine and all of that, and really invest in technological solutions that will be less costly, but usually deliver, a more solid, shorter term ROI, which can ultimately lead to a longer term ROI. Speaking of CapEx, I would just say that, again, if we're going to slow down a little bit and we have a responsibility to shareholders, we really need to prove ROI on big CapEx. You're thinking about that $1 million machine. You might want to think more around strategic alliances. Who else has that machine? Can I outsource that work without, taking on more debt? And just getting creative so that you think a little bit more defensively, going forward for the next year or so.
Got it. I agree with that 100%. I look to engage new technologies wherever I can, so that I am ahead of the curve when things happen. But let's get to the bottom line here. Sounds like you're advocating CEOs be smarter and wiser about debt, de-risk, and how they can measure and I guess anticipate the exit plans and build better value strategies to be able to make money during the good times as well as the bad. Am I correct on that?
Yeah, and I think the principle that on a personal level for CEOs watching your show, we have been for the last several years, even though growth has been hard to come by, we've been very focused on growth and making the hay while the hay is to be made. There's cheap debt, availability of capital, looser lending standards, etc. And I almost want to encourage CEOs to take personal stock and personal time, set aside time to work on your business, think about these longer term strategic decisions, start to shift your mindset more along the defensive track to make sure that you can hold on to that value. And for those that are not willing to do that, or it's not in their DNA, the market still, it's a great time to sell a company because we are still technically in that peak of the market as far as multiples that are being paid. So, you still have options available, but I guess my warning is, here's your sign. There's several things about the economy that are saying there's change afoot. So let's just be smart and let's just protect our shareholders and look to hang on to that value and build value during the downtime. we're starting to get, one more indicator. We're getting several private equity investors that are looking at companies to purchase companies. They're saying, I think we might sell a few more of our assets at the peak and we'll wait to buy on the dip. So, certainly I don't want anyone out there to, if they can get a 7X today in selling their company, maybe that's a 6X or a 5X a year from now or 2 years from now. So just want to think about your timing carefully.
Good food for thought. Craig, thanks for being a guest on today's show. Learn something again every time when you're on the show.
Thanks so much for having me. I appreciate it.
My pleasure. All right, thanks for watching CEO Money. Don't forget, like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.